So these guys are one of the big players in the AI race with a stake in ChatGPT, which we're all quite familiar with now. And they've had a cool 26% compound annual growth rate return in the stock price over the past 10 years, 26%. It's essentially been a 10 bagger in those 10 years. And the business world still runs on Microsoft, and they continue to find ways to just make a truckload of money. So the question is, should we invest in Microsoft and get on board that AI wave and probably the leader in the space? And what we'll try to do is figure out how much growth do we think is possible moving forward. All right, let's jump in and figure it out. Okay, I'm going to get a feel for the growth rates by calculating the last 5 years of revenue growth, gross profit growth, and operating cash flow. So in 2018, I'm in TIKR Terminal, by the way. There's a link in the description for that if you want to access the data like I'm doing. So, okay, we're at 110 billion to 211 billion. So I pop that into a compound annual growth rate calculator for the last 5 years, and we get a number of, okay, so about 14% for revenue growth. Gross profit, we've gone from 72 to 146. And that gives us about 15. Then I go into the cash flow statement and I look at cash from operations, and we're looking at 43 to 87. Which gives us about 15% as well. So the past 5 years has been quite kind to Microsoft, growing at around about that 15% range. The question is, can it continue in the future? If we look at just sort of the last sort of year or two, especially if we look at the revenue the last year or two, it only grew at about 7%. Before that, it was sort of set, well, they got 17, 18, 13, 14, 14, then 6%. So I guess some years they're going to have that 6, 7%. Some years they're going to have closer to 20. I'm pretty comfortable keeping this going at around about somewhere between 10 and 15%. Now, after reading the annual report, I got a feel for, like, we got ChatGPT, we've got a lot of other products that Microsoft are developing, but being so big, they're going to really struggle to grow anything faster than 15%. I think I feel uncomfortable going higher than, I even feel uncomfortable at 15%, but let's be optimistic and say that they can keep it up at 15%. Let's just slow it down a little bit to just be a little conservative for the 5 years after that. Who knows? Like, that's 10 years is a long period of time. Like, I don't know about you, but like 5 years ago, if I look at who I am as a person 5 years ago, I changed so much. So companies change so much in 5 years as well, let alone 10 years. So this is pretty difficult to do, but we're just trying to get a feel. So I've got 15%, then 13%. My discount rate, I've got at 10%. So this is a little bit above the S&P 500 returns. Institutional investors chase about 10%. And this is something we're going to use as our fair valuation. I've done this with all of the other stocks just to get a, this is sort of a reasonable return for the risk. Now, the multiple I've put at 20. It's a great company. It's one of the biggest companies in the world. It's rock solid, etc., etc. I think it could be worth 20, especially with those growth rates. I think that's fair. Now, operating cash flow minus maintenance capex. What I've done to calculate that is I've got the operating cash flow number here from the cash flow statement. Then I Googled Microsoft maintenance capex. And it told me that the 5-year average of maintenance capex is 17 billion. So what I've done is I've just subtracted the 17 billion from the 87, and it gives us about 70. And that's a pretty good feel for the real free cash flow. Because if you're just in TIKR and you're looking at, if you scroll down the bottom, you get a free cash flow number here. It tells you it's about 60. That's not fair, because some of the CapEx is used for growth, the capital expenditures. So we want just the maintenance CapEx, which is what I've been able to uncover here, and that's why this is a better number. The shares outstanding number here, total cash and total debt. The total cash and debt I just pulled from the balance sheet. I'll show you quickly how I did that. So here in the balance sheet, total cash and short-term investments, it was there's 111, and the total debt number down the bottom here, it says it's 79. So and that's in the billion, so 111, 79. Okay, so we have a fair valuation of around 342. So as you can see with the growth rates, it requires a lot of nuance and a lot of research, because there are always going to be slight changes with new things that are coming out from Microsoft. And I'm going to keep track of all of this in a weekly report that I call Yes Stocks, No Stocks. There's a link in the description. Now, it isn't some boring newsletter. I just go straight into the valuations. So there's no BS, there's no fluff. Look, you can get it each week for free, and I highly recommend you joining, because I've done a lot of the heavy lifting for you. Now, if I go into a 5-year valuation model, what I've done is I've just put in the current revenue and I've just got to put in this growth rate for the next 5 years. We'll call it 15%. That's pretty aggressive. This is quite an optimistic scenario, I would assume. The free cash flow margin I already figured out was 33%. To figure that out is I just go, what percentage of the 212 revenue should be free cash flow? And we've already calculated the free cash flow was 70 billion from before. So that's sort of how I figured out the margins must be 33%. And I fact checked that on previous years. So what I did was I looked at the cash flow statement. I went down to the free cash flow margins and had a look at whether 33 feels about right for those numbers there. And it does. So it sits around the 30, somewhere in 33 is even a little bit high, but I'm happy to call it 33. Then we got a fair future price to free cash flow of 20. I've explained why I did that. They are buying back shares more than the stock compensation. So it's not quite 1%. It's about 0.6% of not dilution of share buybacks. So I've even increased that a little bit. Shares outstanding and the current market cap is actually 2.5 trillion at the moment. So the growth rate we wanted to call 15%. Okay, so we have a 5-year target share price of around 390, which would give us from the current share price around about our 3% compound annual growth rate. So what was our DCF? 342. And now what I want to do is I want to get this compound annual growth rate up to 10%, and that gives us what we would call the fair value. So if I turn that into 2 trillion, it needs to be a little less than that. Okay, so 1.8. So if I go 1,800 divided by 2,500 gives us this, and I multiply that by the stock price. Okay, at the moment for me is 338. Obviously, you have to do these calculations depending on what time you're watching this. So about 250, 243 we have as a fair price for our 5-year model, 243. So somewhere between 240 and 340. I'm happy to call that around about 300. It's about somewhere in the middle. It's not quite 290 would be in the middle, but 300 is a nice round number. We're trying to get a ballpark here. We're never going to be like the difference between 290 and 300 is not worth worrying about. We're just trying to get in the ballpark, in the vicinity. All right, so now what I want to do is if I've got the fair valuation of being about $300 a share at the moment, I want to figure out how do I get a better return? So if I want to get this compound annual growth rate up to say 22%, at what number would I have to buy this at? Okay, at a little over 1 trillion. So for it to go to 1 trillion, we have to go down quite a significant amount from the current stock price. So yeah, it looks like over 50%, looks like about 60% down. We would want to be buying this at, looks like about 140, somewhere like that. And my DCF model, if I go back here and I put my return that I want up to 22%, it says I want to buy this about 146. So it looks like around that 140, 150 mark would get us the 22% return if the growth rates stay true. If the multiple we can get is 20 at the end. Yeah, and what's that? What did I say? 140 for a buy price, considering the price at the moment is 338. We're a long way away. Now, remember, I was being pretty optimistic with those growth rates, so I feel pretty good about this valuation, and I hope you've enjoyed the video, and I'll see you in the next one.